You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Persimmon, Dominos, Vistry, Keyword Studios, Berkeley Group, and Sea. Sam, shall I kick us off with Persimmon?
Yes, our first house builder of the week.
Yes, one of three. So it's the York-based house builder, and they have their full year results out, with full year revenue falling 27.5% to £2.8 billion, driven by lower volumes as completions were down by around a third to 9,922 new homes. This was partially offset by a 2.9% higher average selling price of £255,752. Underlying operating profit came in at £0.4 billion, down from £1 billion a year earlier. Lower volumes and higher prices of build cost inflation saw underlying operating profit margins roughly half to 14%. There was a free cash outflow of £165.2 million compared to an inflow of £372.7 million in the prior year. The group has a net cash position of £407 million, and that's down from £851 million last year. In the first 10 weeks of 2024, average weekly sales rates came in at 0.59, and they have improved ahead of the prior year levels. Full year completions are set to land in the range between 10 and 10,500 new homes. And there's a full year dividend announced of 60p a share, which was in line with the prior year. And the shares were down about 3.6% in early trading. In terms of valuation, Persimmon has a market cap of £4.1 billion and has a forward price to book of 1.23 compared with a 10-year average of 2, and it yields 4.7%. I think these results were disappointing, but as we're seeing with the house builders, this is about where we are in the cycle. Persimmon, it's largely outside London, I suppose fairly middle of the road. They have had some build quality issues in the past. And obviously the big hit to them is where we are in the cycle with the interest rates, but also the ending of Help to Buy. They were a big beneficiary of that. I think going forward, you can see it reflected in the price, but I would be more optimistic. I think as we're expecting interest rates to come down, perhaps a bit more stimulus into the housing market, depending on whether it's this government or a new administration coming in later in the year. And again, as we always say, the structural imbalance in terms of the UK housing supply and huge demand. So I would be fairly bullish on quite a lot, on the sector as a whole, and Persimmon as a fairly decent one of the house builders. Probably not my top pick, but it would be up there. Sam, what are your thoughts on these results from Persimmon?
Fairly similar. I think, I'd agree, disappointing, but also not that surprising. We have looked at some other house builders recently. They're pretty similar. I was surprised that they'd managed to increase the average selling price. I don't recall seeing that in any of the others. I don't know if that's just where they're positioned in the market in comparison, but I don't recall seeing the others increase the average selling price.
No, I suppose it's an interesting point, and that kind of sort of middling, or lower to middling, rather than some of the higher ones. I know Redrow had been, I guess, slightly bigger houses and more in the south, but it's an interesting point you make.
Yeah, I think that's probably the main thing I'd have to comment. I'm sure we'll get into more detail as we compare it to the other two that we've got. So I want to save something for later.
Yeah. All right. Well, on to Domino's then. Domino's UK.
Yes. I don't know if I'd go as far as to describe it as a favourite of a show, but certainly a business that we've both liked in the past, although neither of us have ever owned it.
I mean, we wish we'd owned it 20 years ago. I think
it's
about a 48 bagger since 1999. Are we talking
about the US one now, though?
No, we're talking about the UK one.
Oh, my Lord. Yeah. So I've only looking at a 10-year graph, and even that's It's pretty decent. But
Yeah.
I mean, over 5 years, it's only up 60% anyway. If that makes you feel any better.
Favourite of Terry
dividends.
Smith. I think it was one of the original stocks in Fundsmith.
Yeah, very, very good business. But we will get onto it now. No spoilers. So Domino's have come out with their full year results. And this is the UK Domino's. They've come out with their full year results for the year ended 31 December 2023. And system sales were up 5.8% to 1.57 billion. Group revenue was up 11.1% to 680 million. Underlying EBITDA was up 3.6% to 138 million. Underlying profit before tax was pretty flat at 101.7 million. Statutory profit before tax was up 40.9% at 115 million. Underlying basic earnings per share was down 4.3% to 18.4p a share, and the statutory earnings per share was up 48.9% to 28p a share. And the full year dividend was up 5% to 10.5p. The main difference between the underlying and the statutory results is there's a £40.6 million profit on disposal for the German associate, and that's been stripped out for the underlying results, whereas it's included in the statutory. They've said that they now expect to have in excess of 1,600 stores in the UK and Ireland by 2028, the end of 2028, and in excess of 2,000 stores in 2033. And they're expecting to deliver 2 billion of system sales by the end of 2028, and that's compared to just under 1.6 billion at the moment, and 2.5 billion in 2033. They returned 90 million to shareholders in 2023 through buybacks, and that's on a market cap of 1.42 billion, so it's a decent amount actually. They've highlighted that they continue to gain in the UK takeaway market, and the market share gain was 0.1%, up from a 7.1% market share to a 7.2% market share. They've accelerated the store openings with 61 new stores opening the year, and they expect to open in excess of 70 new stores in 2024. The total orders were at 1% to 70.5 million on a 52-week basis, and the collections were up 13.3% to 25.3 million. Delivery orders were down 4.8% versus 2022. I'm just speculating here, but they've obviously done pretty well with, orders up 1% overall, but with the collections being up quite a decent amount and delivery orders down, I do wonder if that's with the cost of living crisis. Are people just going to collect it to save the extra £2 or £3? That's my theory. Average franchisee store EBITDA was up 9% versus 2019, which is the pre-COVID year. They've continued their digital progress with significant growth in app customers and orders, and they have 9 million active app customers, up 48% versus the prior year, with app orders as a percentage of online sales up 21.6 percentage points to 73.8%. Following a strong first full year on Just Eat, they've started an Uber Eats trial in January 2024, and that's now live across 630 stores in the UK and Ireland. And they've had meaningful improvement in the average delivery time, down from 26.3 to 25 minutes. I didn't think that was something that was an issue for them, but it's good to see that they are still working on it. They've also announced the acquisition of the outstanding shares of Shorecal Limited, which is the Irish venture that they have, which they don't currently own 100% of. So they're buying the outstanding shares for 62 million. That's an EBITDA multiple of 8x, which doesn't seem that expensive. It's expected to add to earnings in the first full year of ownership and significantly in the long term. And they've said it will give them the ability to take control of a significant opportunity to materially increase the store count in Republic of Ireland and Northern Ireland. The existing Irish management will remain in the role to accelerate the growth. And for the current year, they've said they expect to see some food cost deflation for 2024, which in line with their model will be passed through to the franchise partners. And they've also said that they're committed to offering customers compelling value, and a new £4 lunch offer will be launching shortly, providing an incremental opportunity to target different parts of the day. In terms of the valuation, the business trades at a PE ratio of 20 and has a dividend yield of 2.91%, although that doesn't exclude the buybacks, which are pretty decent. I really like this business. I say it every time we cover it. I don't own it. I've never owned it. For me, there was an opportunity probably in like 2022. You could have got it about £2.50 a share. It's at £3.60 now. it's been as high as £4.50. I just think at 20 times earnings, I think the growth targets are reasonable. I think they're realistic. I think there's an opportunity with the Republic of Ireland, although that's not going to be a huge market compared to the UK. But I just think at 20 times earnings, the growth targets, they're not outrageous and they're pretty achievable. But I think at 20 times earnings, they're probably already priced in. For me, it is a business I would be really interested in owning, but it would have to be at the right price. And I think for me, the PE would probably have to come down probably about 15 for me to take a serious look at it. I do probably slightly prefer it to Greggs as a business. What about you, John?
I mean, I like both Domino's and Greggs. I suppose looking at Domino's UK, it's just how saturated it is in the market. And I suppose scope from growth, going forward, that would be my concern. And that's probably why I wouldn't buy it. And I suppose you could probably have said that for a long time and it has continued to deliver, but it's a tricky one. I do like what they're doing. I think it's incredibly well run, and the fact that they're making use of, or going to be making more use of, like Uber Eats, I think is great, because that's the part of the business that you don't like as much, the delivery, or them having to pay for costly delivery. And if someone else is willing to take that on, it would be good to make the business more efficient in that sense.
So you talked about the saturation, but I think those targets are pretty reasonable. So it's always, when we compared it to the Greggs, it's always an issue we've had that we always felt Domino's targets were much more realistic than Greggs. Now, Greggs has actually gone and achieved what we consider to be the unrealistic targets, but I don't think that makes the Domino's ones any less realistic. I think for me, it's like I said, the issue is the targets aren't outrageous. I mean, they want to increase the store count by 25% in the next 5 years, and that includes the Irish market, which obviously they will probably. Okay. Then 25% increase, assuming that flows through to earnings with the same kind of margins at a P ratio of 20 already. I mean, it's not. It's like I say, it seems like it's priced in. So I guess what I'm saying is, if the PE were lower, is it a business that you would consider? Or do you just feel like it's so saturated that you probably?
I feel more that it is so saturated, even if it were cheaper. I think that's my problem with it.
I guess as well now, I mean, it's a good thing they have, but a lot of the overseas ones, apart from Ireland, that weren't very successful. Like I think the Scandinavian one, did they have? They had a Germany one as well, but they've gotten out of a lot of those markets, which is good because it wasn't working, but it also means the growth opportunity is limited because this is purely a UK and Ireland story.
Yeah, exactly. So that again, it's sort of, I suppose you say, well, opening 25% new stores and some of the growth, but I don't know. I do struggle because I feel like Domino's are everywhere, and wherever you are, it feels like it will be here in sort of 20 minutes or so.
25.
20, sorry. But that I think that's where I come to struggle. I did have, in fact, this year I have had quite a few. So maybe it's a Peter Lynch that I need to look within my own life. But anyway, fantastic company either way.
All right, should we move back to house building?
So Vistry Group, we've covered it a while ago, but it's the UK's leading provider of affordable mixed tenure homes. They had their full year results out last week with full year underlying revenue up 29.8% to £4 billion. And this reflects the enlarged size of the group after a full year's contribution from the Countryside acquisition in November 2022. Underlying operating profit grew at a slower pace of 8.2% to £0.5 billion. An increase in volumes of the less profitable partnership sales caused the associated margin to fall by 2.4 percentage points to 12.1%. Free cash outflows worsened from £8.4 million to £74.9 million, and net debt stood at £88.8 million at the year end, down from a net cash position of £118.2 million. Weekly sales have risen to 0.72 since the start of the year, compared with 0.61 in full year 23. Weekly sales rates have risen to 0.72 since the start of the year, compared with 0.61 in 2023. And in 2024, Vistry expects to deliver around 17,500 new homes, which is up from 16,118. Over the medium term, revenue is expected to grow by 5 to 8% annually, and underlying operating profits are expected to reach 800 million. A new £100 million share buyback programme is set to commence in April, and that's in place of the final dividend payment. The shares were broadly flat in early trading following the results. In terms of valuation, Vistry has a market cap of £4.1 billion and trades at a forward price to book of 1.1, which is broadly in line with its average since listing, and it has a prospective dividend yield of 4.4%. In the climate, I thought these results were pretty reasonable, but it is a different end of the market, and it's partnering with local authorities, housing associations, which arguably are less cyclical, but then they do come at lower margin. It does have an impressive order book of £4.5 billion, but I think, to be honest, it's the sector that would put me off compared with some of the other peers that are, kind of almost exclusively private. I appreciate some of them do have sort of small amounts of shared ownership and affordable, but much, much smaller. So for that reason, it probably wouldn't be one for me. But it's interesting to see how they're doing in comparison with those kind of all entirely private house builders. Sam, what are your thoughts on these results from Vistry?
I'm not sure what they actually do. I should probably know, because I feel like it was me that presented it last time we had it on the show.
So in terms of Vistry Group and their sales, they have partner sales, which account for 65%, and that's the part. Well, a large part of that is the Countryside acquisition, with that accounting for 65%, multi-tenure housing solutions, joint ventures, affordable housings, PRS, and partner delivery. And then you've got the retail sales, so that actually has Bovis, Countryside Homes, and Linden Homes. So it's sort of 35-65 in terms of the breakdown. But obviously, when you look at sort of Persimmon, I think it's maybe less than 5%. It's those sorts of figures. So obviously, it's got a much larger part.
35% that's retail. Then that's basically someone's buying a house and they buy it off Vistry. That's
yes,
the 35.
Exactly.
So who buys the other 65? Is that the government?
The housing solutions, affordable housing. Yeah, it's
like councils and stuff.
Councils, yeah.
It's interesting how much better it's done.
It is. And I think that, what sort of reading the results, it seems to be down, compared with the others, seems to be down to that factor.
That is interesting. I know it's lower margin, but it's more resilient, isn't it?
I suppose it does have some sort of defensive quality there, but
it ebbs and flows with government policy is the issue, though, isn't it?
Yeah, that's right. So I suppose, almost if you had more knowledge of the sector in that sense and feeling for the direction things were going, but I would prefer personally just to have one of the more traditional house builders, and they'll have sort of more affordable homes in the portfolio, but it's not kind of reliant on government in that sense.
Yeah, I'm not a fan of something that's dependent on government policy. I think you can make a strong argument for having it as part of a basket, though, if you were to get a few house builders.
Yeah, I guess you could, but how much difference would it? Yeah, do you think?
Well, I guess it's more that if you get that change in government policy, it's just one of your holdings that gets absolutely hammered, and you're basically diluting that percentage that is dependent on councils.
Yeah,
I guess true. If you want to do that, maybe you just shouldn't buy it.
Yeah. It's tricky. Anyway, it's slightly different to the other ones we've got on this week. The other thing I should point out is that it's the cheapest of. Well, we'll come on to the last house builder soon, but it is the cheapest of all of them.
Well, this one is.
Yeah.
Vistry.
Yeah.
Even though it's got the best results.
Yeah.
I suppose people are discounting the fact that there's a general election next year.
Yeah, well, exactly. Anyway, on to Keyword Studios.
Yes, so it's a business we've covered a few times before. It's a business that we've liked as well. They are AIM listed, and for anyone who's not familiar with them, they are a provider of creative and technology-enabled solutions to the video game and entertainment industries. They provide services across the entire content development lifecycle through their create, globalize, and engage divisions to large blue chip client base across the globe. They have a strong market position, providing services to 24 of the top 25 most prominent video game companies. and contributing to over 70% of the 2023 Game Award winners. So what they will do is you've got the games developers, sort of like your Microsofts and your Activision Blizzards, although I know that's now owned by Microsoft anyway, but like EA Games and stuff like that. They won't do everything from start to finish in-house. They will use companies like Keyword Studios for some of the background or the outsourcing and stuff like that, and they will sit in the background basically. Yes, as an example, they'll create trailers and PR campaigns. They will do the testing. There's loads of sort of random stuff that they will do in the background to support the game developer. So they have come out with their full year results for 2023. All these figures are in euros, and group revenue was up 13% to 780 million, and the organic revenue growth was 5.6%, with the rest coming from acquisitions. The adjusted EBITDA was up 7.8% to 158 million, and the margin was down slightly from 21.3% to 20.3%. The adjusted operating profit was up 6.5% to 122 million, and the margin was down from 16.6% to 15.6%. The statutory operating profit, however, was down 34.8% to 46.8 million. I think the main thing that's been stripped out has probably been amortization, where that's sort of the value of what they're buying is being written off year by year in the accounts. I think that's what's been stripped out. Adjusted earnings per share is down 0.5% to 112.9 cents a share, and the earnings per share is down on a statutory basis 58.9%. The final dividend is up 10% to 1.76p. And the adjusted cash conversion rate is down 82.3%. Sorry, is down from 100 to 82.3%. And they've gone from a net cash position of 81 million to net debt of 67.5 million. However, that's on a market cap of 1.12 billion. They've highlighted that the full year revenue growth was 17% rather than 13% on a constant currency basis, and that was driven by robust organic growth and acquisitions. For the organic revenue growth of 6%, that would be 9% if you excluded the impact of US strikes and FX changes. They've said the net debt change was just due to strong acquisition activity. And they've had a record year for mergers and acquisitions, with 5 high-quality acquisitions for maximum consideration of 225 million, extending high-value offerings in Create and Engage, and adding 90 million of pro forma revenues. So that's a decent amount. They've probably added 20 to 25% of the market cap in acquisitions. The recurring credit facility increased to $400 million, with maturity extended to 2027. Which they've said cements their long-term liquidity and flexibility to pursue their strong M&A pipeline. And they've got an extensive pipeline of opportunities in 2024. And they've also mentioned, this is in the CEO's statement, they've talked about the market opportunity, and they've said, after a number of extremely strong years of growth in 2023, the video gaming industry saw a mixed performance. Major titles that had been in production for a number of years were released to commercial success, such as Hogwarts Legacy, Starfield, Diablo, and Baldur's Gate 3. But the broader industry saw publishers focus more on profitability than taking risks around new content. This meant we saw a focus on core IPs and smaller scopes for launch of some titles, with an increase in the number of games being delayed or cancelled. They've also said that as a key player in this market, more than 3x the size of our next largest competitor, yet with a market share of 6%, we believe we remain incredibly well placed to grow our market share in a highly fragmented market. They've said industry forecasts continue to point to long-term growth in the market, with growth in content creation segment expected to be above the overall market, with a 5-year compound annual growth rate of 8%. It's normally trading about 30 times earnings, which will probably be around the share price that you remember it, John, from when we last covered it.
Pricey.
Taken a real battering in the last year on the back of all the AI stuff.
Yeah.
So it's actually taken a battering from it. So I think there are concerns that a lot of the outsourced jobs that it's doing from the big game developers could in theory be done by AI if it was good enough. I think in response to this, they did recently try and get an AI to actually make a game, and they sort of released the results, and their conclusion was it didn't work. So I don't think they're too concerned. Maybe internally they're probably slightly more concerned, but the share price is down 46% in the past 12 months, and it now trades at a P ratio of just under 15. It has a yield of 0.18%, and this is a business that has more than doubled its revenue and its operating profit in the last 5 years in what should be a very good big growth market. Like any industry, video gaming could be impacted by AI, but what's to say that Keyword Studios couldn't benefit from it as much as it's going to damage them. I suppose the argument is that the bigger game developers can use the AI to do the stuff that Keyword's doing, but I think it's probably a long way away from that. And yes, the future's maybe uncertain with it, but it's probably always uncertain in this kind of industry. I think for a business of this quality that's been putting up the kind of results we're used to seeing from Keywords, and this is, all things considered, it's a pretty decent set of results. The growth's pretty good. I think the mergers and acquisitions look pretty good. They're not, not really any significant debt to worry about. I think it ticks a lot of boxes, and I think it looks like a very good business. So yeah, I think at 15 times earnings, it might be worth a bit of more of a dig. What about you, John?
Yeah, no, I tend to agree with you. It's certainly one that is appealing, and at the current valuation, I suppose it's probably doing quite a bit more research into, I guess, games development and how realistic it is in terms of AI, and whether that is such, that's such a genuine threat that would account for the shares, halving. But it's really difficult to know. But if you look at the results and you look at the valuation now, I think it makes it worth doing that research for sure.
So is the conclusion then that it's probably going to end up in the too hard pile?
I mean,
or is it cheap enough that you could take a punt?
It's getting to that point, I think. But
yeah, I think I'd need to go through it and read it in more detail.
And it's AIM listed, I think, isn't it?
It is, yes.
Yeah, it's interesting.
But I mean, it's a business we know every time we've covered it. I think we've done it, at least a couple of times before, and we've really liked it. And the issue we've had is it's been at 25, 30 times earnings, and 15. It's a completely. And I literally haven't looked at this since the last time we covered it on the show, so I didn't expect to come in and find it at 15.
Yeah, and if it does keep growing in the short term, that valuation at 15 is going to come down even further. Yeah,
I just think I do kind of think, I mean, need to do look at it a bit more, but it's kind of like there will be stocks where on the back of AI, they have just been run up to stupid levels.
Yeah.
And has this sort of been run down in a similar way?
Yeah.
I don't know, but I'm surprised with the results it's had to have seen it take such a battering, because on the surface there's not really, I really struggle to find it, because I know there's some stuff like, in the statutory results they are down a bit, but I think that's just amortization. There didn't seem to be, I couldn't really find anything that was like inherently wrong with the business. So I was kind of like, well, what's actually going on here? Because something's obviously happened, because it's down 50%. So I had a look at a couple of articles, and it does look like it's just taking a battering because of concerns about basically AI taking over and replacing it and making it completely redundant.
Yeah, and that would make sense as the explanation to that, and it coincides or correlates well with, I suppose, Nvidia's rise.
Yes, yeah. So that's probably a good comparison, actually. So so I think I'll be taking a more serious look at this.
Yeah.
Should we move back to house building?
Yes. So third house builder of the week, Berkeley Group, and they had a Q4 trading statement out last week, with Berkeley's sales rising in the 4 months to the end of February, in line with the prior 6 months. And this level marks a decline of about a third year on year. The order book, which was sitting at £2 billion at the half-year mark, has continued to moderate over the second half. The net cash position at the year end is set to be above the half year, and that's about £422 million. Berkeley expects to deliver full year pre-tax profits of around £550 million, in line with the current market consensus. Medium-term profit guidance has been reiterated, with at least £1.5 billion of pre-tax profits over the next 3 financial years ending April 2026. The previously announced interim dividend of 33p per share will be paid on the 29th of March, and through a combination of dividends and share buybacks, the group plans to return a further £227 million to the shareholders by September 2024. And the shares were broadly flat following this trading statement. In terms of valuation, Berkeley has a market cap of £4.8 billion and trades at a forward price to book of 1.38. So it is the most expensive of the house builders today. The group, it's looking healthy, and it does have decent cash reserves. It has built generally bigger homes and more, I guess, more premium, the more premium end, and it has had juicier margins as a result. I think broadly in line with Persimmon in the sense that with the sales, and I think when things get going again, it's going to be obviously a big beneficiary, get those margins back up. It's an interesting one. It's not one that I focused on too much in the past. It's more been the Taylor Wimpey's, Redrow and Persimmon, and I've owned all three of those ones before. Possibly worth a deeper look, although I'm quite happy where I am with Redrow at the moment. It'll be interesting to see how it plays out over the next cycle as it comes back in. Sam, what are your thoughts on this trading statement from Berkeley Group?
Pretty similar. There's not, I mean, I don't own a house builder, but there's not, don't know if it's one I would go for at that higher end of that. I suppose one thing that's good about it is there's probably not going to be any impact from Help to Buy going, because you couldn't have bought its average home on Help to Buy.
Exactly.
$624,000. So that's probably pretty good, and possibly maybe why the valuation's held up a bit better than some of the others. But yeah, I'm sure it's pretty good, and there's nothing to suggest it isn't. But I would prefer to probably be in the end of the market that you are. I don't think I'd go quite all the way down to Vistry, but yeah, I don't know with Berkeley. It may be worth a look. I think I'd have it over Vistry.
Yeah,
I'm sure it is a decent business, but yeah, and it's hard as well because I've never really looked. I know we have covered it before, but I don't think I've really looked in massive detail on the business. And there's not loads in this trading statement to actually go off. And I think if it wasn't for the fact that we were doing two other house builders, would we have picked this trading statement? We probably wouldn't, but it's useful to compare to the others just to see how they're all dropping together. Well, apart from Vistry, but in terms of the middle and upper end of the market, are both dropping, where the lower end's doing actually still fairly well. But yeah, not loads to say other than that, but it is interesting to have a look at it because we don't cover this one as often as some of the other house builders.
Yeah, and it's interesting. I'm just looking at their developments in new homes in Oxfordshire, and houses start at 450 and they go to 91.
That's quite cheap for Oxfordshire.
Well, yeah, I mean it's Wallingford, but anyway, I think when you compare it with, for example, Persimmon and the average selling price being 250, it's significantly above that. And I guess when it comes to using your lifetime ISA, whatever else, it's sort of above that too. I haven't looked at the new homes in London. Yeah, and I'm just looking at some of those 810 to 845, and that's more, I think, looks more like flats rather than a home. So anyway,
we got about 20 square feet as well.
Yeah, it's probably about that. 1 to 2 bedrooms. Yeah. Okay. So on to our US company of the week.
Yes. So US listed, but this is actually a Southeast Asian company. So it's Sea Limited. I don't know why it's called Limited. I think it must be like a Southeast Asian thing because obviously limited here does not mean the same thing as this one because it is not. It's actually it's a public company. It's not limited at all in that sense of the word. But they're called Sea Limited. And they're listed on the New York Stock Exchange. And the easiest way to think of them is probably and it's a dangerous analogy, it always is, but the Amazon of Southeast Asia. I think we may have covered them once before on the show in the height of the pandemic. And I think they were trading at about 17 times revenue.
I remember that.
Yeah. So the business is split into three main parts. So they've got basically like sort of like their equivalent of like PayPal, their equivalent of Amazon, and then they've got like a gaming division where they do basically mobile games, which we'll get into in a bit more detail. But they have come out with their full year results for 2023, and all these figures will be in dollars, by the way. Total revenue was up 4.9% to 13.1 billion. Total gross profit was up 12.5% to 5.8 billion. Total net income was 162.7 million. That compares to a 1.7 billion loss last year. So got net income for the first time. In terms of the e-commerce division, the revenue was up 23.5% to 9 billion. Adjusted EBITDA was a loss of 230 million compared to a loss of 1.7 billion last year. Gross orders were up 8.8% and gross merchandise volume was up 6.8%. For the digital financial services, revenue was up 44% to 1.8 billion. Adjusted EBITDA was 550 million, and that compares to a loss of 228 million last year. And in digital entertainment, revenue was 2.2 billion compared to 3.9 billion for 2022. And adjusted EBITDA was 920 million compared to 1.3 billion for 2022. in the CEO's statement, so Forrest Lee, he's also the founder as well. He said, "I'm happy to share that we've achieved our first full year of annual profit since our IPO. We've emerged with a much stronger balance sheet, with our cash position increasing to $8.5 billion as at the end of 2023, demonstrating the discipline and prudence we have applied in our investments over the past year. Looking ahead, we expect 2024 to be another profitable year. Despite an environment of intensified competition in Southeast Asia, we believe Shopee had a meaningful gain in market share between the start and the end of 2023. For Sea Money, 2023 was the first year of positive profit, primarily attributed to our consumer and SME credit business. In 2024, we will continue to invest in user acquisition for our credit business, both on and off the Shopee platform, as we see significant upside in our markets. For Garena, I'm happy to share that we are seeing improved user acquisition and retention trends for Free Fire. In 2023, Free Fire was the most downloaded mobile game globally, according to Sensor Tower. In February, Free Fire achieved more than 100 million peak daily active users. It remains one of the largest mobile games in the world. With this positive momentum, we currently expect Free Fire to grow double digits year on year for both user base and bookings in 2024. In terms of the valuation, the business trades at a market cap of $32.8 billion, and that includes $8.5 billion of cash on the balance sheet. It trades at a PE ratio of 230, and that is a price to sales of 2.5. So that's down quite a lot from, I think, 17x when we looked at it or something stupid. Because the share price is down a lot. It's down from a peak of about 350 to under $60 a share now. I think with the price of sales, though, I'm not sure how useful it is, because because so much of the business is from that online retailer. If you were to look at Amazon and say, well, yeah, that's what it's going to be, that's quite low margin anyway. So I wouldn't use price to sales in any case, I don't think. In terms of price to gross profit, it's only 5.5x, but again, you've got the same issue. However, it's only 29 times the free cash flow, which I don't think is terrible, considering you've not just got the retail, you've also got the gaming, and you've also got the Sea Money. My concerns with this business would be that the Sea Money, which is probably the most, well, it's very interesting, but that's still a very, very small part of the business. If you go through the revenues, e-commerce is 9 billion, the Sea Money is 1.8, and then the gaming is 2.2. So it is a bit of a minnow compared to the e-commerce. The gaming, again, that's higher margin, but it's again a much smaller part of the business. So I think because it is dominated by that e-commerce, the thing with Amazon, the reason it's so successful is because it's got Amazon Web Services sat in the background making all the money. And does gaming and the digital, the financial services have that same kind of power that Amazon Web Services does? Probably not. At 29 times free cash flow, I think you can maybe do quite well on it if you did believe in the business, and depending on where you thought sort of Southeast Asia was in the cycle and how big it could get, it could do very, very well. But I think for me, I'd probably just give it a miss. And one thing that would also be concerning for me is if I compare this to a business that I own, which is very similar, Mercado Libre, which is sort of, the Amazon of Latin America. Mercado Libre had a pretty good COVID period. I don't remember them doing anything particularly stupid. Sea Limited started opening in just so many random countries. They tried to compete with Mercado Libre in Mexico. I think they opened up in Poland. They opened up in India. And a lot of these services outside their core Southeast Asia market, they've just lost a load of money and pulled out. And yes, they've acknowledged the mistake and pulled out. But I think for me, it's not fantastic management that they've gone and done that, because they've gone and said, well, yes, we're doing well in this area, but let's go and take on Mercado Libre over there. Let's go and take on Amazon over there. I just find it slightly naive. So for me, I think the valuation is a lot better than the last time we looked at it, and possibly make an investment case for it. But I think it's still not a business for me. What about you, John?
Yeah, I think there are lots of unknowns about it, and the valuation. I wouldn't enjoy watching it, but I wouldn't go near it with my own money.
I think despite being down over 80%, I still don't think it's not incredibly cheap.
But that does just show, over COVID, how much it rose. I mean, I think it was up 7 or 8 times in 9 months or something.
That sounds right, based on the share graph.
So, Sam, of the companies this week, what would be at the top of your list, and what would you leave well alone?
So it would need more research, but I think probably Keyword Studios. I think the valuation looks really, really like it could be potentially quite attractive. I think last would probably be Sea Limited. I'm not massively keen on the Vistry business model, but it is doing quite well and it seems like a fairly reasonable valuation. I think probably your potential for loss is a lot lower in Vistry compared to Sea Limited. Now you might 5 or 6 extra money on Sea Limited, but for me there's too many unknowns. I'm not a huge fan of the management and it's still quite expensive. So Sea Limited would be quite an easy last for me. What about you?
Fine. I would go for Persimmon as the first choice. It would be my pick of the house builders from this week. And then it would probably be Sea Limited for the reasons we've just said.
Oh, okay. I didn't think you'd go for Persimmon. I thought you'd have gone for Keyword.
I think Keyword needs more research, basically. That would be where I would be with Keyword at the moment. If it was a fantasy portfolio, then maybe it'd be a bit exactly. When it's your own, taking it seriously, Sam, it would be Persimmon. Okay,
I think that's everything then.
Yeah, thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.